Welcome to an accounting podcast. We are accounting students from Atmajaya Catholic University of Indonesia.
My name is Bella Marcia.
My name is Sabrina Olivia.
My name is Sherlyn Marcianda.
My name is Tiffany.
My name is Victoria Bella.
My name is Yostian Hadinata.
We are here to talk about accounting in corporations. Please enjoy.
Well, hello Vicky, how are you? So, this is gonna be the first section of this podcast. Woohoo! Actually, this is my first experience making a podcast, and I'm a little bit nervous, but let's try!
Hi Sherlyn, and of course, all of the listener. I'm fine, thank you, but I'm feeling a little bit nervous too. But we need to be confident. And so today we're going to talk about corporations. Let me ask you first, what do you think about corporations?
I don't really know about corporations, but I think corporations are a legal entity created by individuals, stockholders, or shareholders with the purpose of operating for profit.
Good answer, Sherlyn. Corporation is a legal entity, distinct and separated from the individuals who create and operate it. As a legal entity, a corporation may acquire, own, and dispose of property in its own name. It may also incur liabilities and enter into contracts. Most importantly, it can sell shares of ownership called stock. Issuing or selling stock gives corporation the ability to raise large amounts of capital.
Oh, okay. And I know there are two types of corporations, right? C corporations and S corporations, but I don't know the difference. Can you tell me, please?
Well, C Corp is a business entity that is legally separated from voters, referred to as shareholders. Taxation is also separate and occurs on a corporate level as a separate entity. The owners are not personally liable for business losses, while the corporate structure provides liability protection. Owners and employee can still be liable for negligence, while S Corp is a flow-through corporate structure and is not taxed at the entity level. Then, the biggest difference between C and S corporation is taxes.
So taxes are the biggest difference. Can you explain it a little bit more, Vic?
So, C corporation pay tax on its income, plus they pay tax on whatever income they receive as an owner or as an employee. While an S corporation, they doesn't pay tax at all. Instead, they report the company revenue as a personal income.
Oh, okay, I see. Oh yeah, Vic. How about the characteristics of corporations?
So, there are a few characteristics of a corporation. The first one is...
Wait, Vic. I think I remember about the characteristic. There are 5 characteristics, right?
Yep, that's right. The first one is corporation is owned by shareholders. When a corporation is formed, a fixed number of company stock shares are issued. Stock shares can be owned by one person or many shareholders.
So, after that, how about if the corporation goes public?
So, when a corporation goes public, it means that they sell their ownership in form of stock in the stock exchange. And there are potentially millions of owners to any given company. Shareholders are allowed to vote based on the number of shares they own. The more shares the owner has, the more control they have over the company's decision.
Alright, I remember that when a corporation goes public for a first time, they call it initial public offering or IPO. Is that true?
Yeah, that's right. And now we're going to talk about the second characteristic, that is, corporations have professional management. The owners of a corporation may be able to vote on decisions for the board of directors to make final directive on. But the shareholders are not necessarily the managers of the company. For many small businesses, the majority of shareholder is the founder and the main leader of the company. However, It is possible for any corporation to hire a company leadership while also reaping the benefit of the profits. The board of directors votes on major budget items, but there's also disadvantages in this characteristic. The board of directors should represent the interests of shareholders. However, the board is often more closely tied to the management than to shareholders. As the result, the board of directors and management may not always behave in the best interest of shareholders.
I heard that in many cases, the investors who own a company are not actively engaged in its management. Instead, they hire professional managers to handle the oversight of the business on their behalf.
Yes, that's correct.
Oh, okay. The next characteristic is that corporations have limited liability. Am I right, Vic? But I don't really know the explanation about that point.
The explanation is like a corporation grants the owner limited liability against debt and lawsuits filed against the company. This means that any loans, credit card, mortgage, or revolving credit with vendors are the sole responsibility of a company.
Oh, can you give me an example, please?
So, for the example, when a company goes into financial hardship and files for bankruptcy, payroll, taxes, and debts are all paid before any shareholders get paid from the remaining assets. But the shareholders are not liable to pay for any of this if the assets are not enough to pay everything off. Thus, the financial loss that a stockholder may suffer is limited to the amount they invested.
Oh, okay, I understand. And then, what's next, Vic?
The fourth characteristic is that corporations have their own lifespan. A corporation is its own entity, meaning it has a lifespan that only ends when the board of directors and owners vote to dissolve the business. This means a corporation extends beyond the lifespan of its human owners. Stock shares are transferable upon death or have the ability to be sold and transferred from person to person through a public stock exchange or through private transaction for non-public entities. The transfer is the reason why large companies such as Ford Motor Company still exist today, even though their founders died decades ago. Therefore, it exists indefinitely.
So that every corporation will always have their own lifespan, no matter what, right?
Yes, that's right. And last but not least, is considered double taxation.
Why must have double taxation?
For a smaller corporation, double taxation is a significant consideration. The corporation is taxed on earnings. When profits are distributed to shareholders, those are also taxed as dividends. Depending on the overall revenues and how much is distributed to the shareholders, this could have a significant financial impact on the owners. Keep in mind that there are two types of corporate structures, the C corporation and the S corp, to pass through the revenue directly to the owners to mitigate the double taxation. Thus, net income distributed as dividends will be taxed once at corporation level and then again at the individual level.
Okay, thank you for your answer, Vic. Now we reach the end of our segment. We will be back in a few seconds. Bye, guys.
Bye guys!
Belum tahu masuk kampus mana? Masuk Atma Jaya aja. Tunggu apa lagi? Buruan daftar. Klik link di bawah. Thank you.
So, we're entering our second section of the show. Are you guys curious about what we're going to discuss? So, Tiffany, please explain what we're going to discuss.
In this section, we are going to discuss about stocks, focusing on the characteristics of each stock. before we start, let me ask you, how many types of stock that you know?
2. There are 2 types of stocks, am I right?
You are right. Could you mention those two and give a brief explanation about it?
It is common stock and preferred stock. These are 2 main types of stocks that are sold by companies and traded among investors on the open market. Each type gives stockholders a partial ownership in the company represented by the stock. It seems like many people, including me, know about the type of the stock but don't really understand about it. Could you explain more about those 2 stocks, Steve?
Sure. The first type of stock I would like to explain is common stock. Common stock is the most common type of stock that is issued by companies. It entitles shareholders to share in the company's profits through dividends or capital appreciation. Common stockholders are usually given voting rights with the number of votes directly related to the number of shares owned. Owners of common stock have preemptive rights to maintain the same proportion of ownership in the company over time.
For your information, a preemptive right is a stockholder's right to maintain his or her ownership percentage in a corporation when the company issues additional shares of stocks to the new investors. In other words, this right allows current shareholders to purchase their proportionate number of shares in any new stock offering in order to maintain their ownership in the company. So, if the company circulates another offering stock, shareholders can purchase as much stock as it takes to keep their ownership comparable. Without this right, their ownership share will be diluted every time additional investors were allowed to buy into the corporation.
Back to the explanation of common stock. This type of stock has the potential for profits through capital gains. The return and principal value of stocks fluctuate with changes in market condition. The share that is sold may be worth more or less than their original cost.
Wow, it's such a clear explanation, Tiff. Now, let's move for a while to the preferred stock. As we know, preferred stock is generally considered less volatile than common stock, but typically has less potential for profit.
Yes, so preferred stockholders generally do not have voting rights, as common stockholders do, but they have a greater claim to the company's assets. Preferred stock may also be callable, which means that the company can purchase shares back from the shareholders at any time for any reason, although usually at a favorable price.
Besides the preferred stockholders do not have voting rights, is there any situation that makes preferred stock more special than the common stock?
Of course, preferred stock shareholders receive their dividends before common stockholders receive theirs, and these payments tend to be higher. Shareholders of preferred stocks receive fixed, regular dividend payments for a specified period of time, unlike the variable dividend payments sometimes offered to common stockholders.
So, we already heard about the brief explanation about common stock and preferred stock. Now, let's move to our main discussion. It is about the characteristics of each type.
Sure. Let's continue the characteristic of stock. The number of shares of stock that a corporation is authorized to issue is stated in its charter. The term issued refers to the shares issued to the stockholders. A corporation may require some of the stock it has issued. The stock remaining in the hands of stockholders is then called outstanding stock.
Oh, I see. That is why sometimes the issued and the stocks are different. Okay, moving on. The next question is, what are the characteristics of common stock?
Yes, there are 4 characteristics that I'm about to mention here. First, common stocks represent ownership of a company. That means when you hold a portion of the company's total stocks, you are one of the owners of the company. Do you understand what does it mean?
I understand. Let's say if a company has 1,000 shares traded in the market and I hold 100 shares of that company, then I'm the owner of 1/10 of the company. Is that right?
Yeah, you're right. The second characteristic is the voting rights of common stockholders. As a common stockholder of a company enlisted in the stock market, you have the capability of casting the vote while selecting directors' board. The third one, the value of the common stock itself is not concrete. That means the value fluctuates time to time. The value of the common stock is backed by the value of the main company.
Okay, how about the dividend?
The dividend is the most important part of a common stock. The image, capability, or attracting investor vastly depend on the dividend declaration capability. As a common stockholder, you have the rights or capability of receiving the periodic dividend.
So that is the characteristics of common stock. Let's continue to the preferred stock one. What are the characteristics of preferred stock?
The first characteristic is dividend payment priority. It is the most attractive characteristic of preferred stock. Preferred shares pay dividends annually, which is a fixed percentage of stock's purchase price. Corporation has to pay to the preferred stockholders before anyone else.
So that means when the company doesn't have any earnings, then it is not applicable to pay dividends to anyone?
Yes, you're right. The second one is cumulative dividend payments. Preferred dividend payment can be either cumulative or non-cumulative. This system should be considered in the beginning of investing in preferred stocks. The cumulative dividend payment is if a company fails to pay 1 year's dividend to the preferred stockholders, then the company should pay the dividends in the second year with adding the prior year.
Oh, okay, I understand. Please continue.
Next one, preferred stock has a fixed rate of dividend. It is specified as a percentage of the par value, and preferred stocks are also less risky than common stocks. In the case of bankruptcy or liquidation, companies pay preferred stockholders before the common stockholders.
What do you mean by saying less risky? Is it related to bankruptcy?
Yes, in the case of bankruptcy or liquidation, companies pay preferred stockholders before the common stockholders.
Oh, I see. That is why preferred stock is less risky than the common stock one. Now let's continue to the next characteristic, Tiff.
Yeah, so next one is about claims on income and assets. In the event of bankruptcy, preferred stockholders' claims get priority over the common stockholders. Preferred stockholders can claim on income and assets of the company before anyone else.
I never knew about the priority thing. Interesting.
Continuing to the next characteristic, some preferred stock issues have a convertible feature that allows preferred stockholders to exchange their preferred shares into common shares. And the last one that I want to mention is some preferred stocks are redeemable by giving the right to the company to buy back them at a fixed date and price.
If I'm not mistaken, you also mentioned outstanding, issued, and authorized. Now, can you explain about that?
The term authorized, issued, and outstanding refers to shares in a company that have been sold publicly. They are authorized because they fall within the maximum number of shares a company can sell according to its corporate charter.
How about issued and outstanding?
They are issued because they have been sold. They are outstanding because they have been sold to the public, not to the owners or managers of the company.
Besides that, I've heard about the terms treasury stock. Could you explain about that too?
Sure. Treasury stock refers to previously outstanding stock that is bought back from stockholders by the issuing company.
Are there any particular reasons why companies repurchase their stocks?
When a company repurchases stock, it can affect the value of the remaining outstanding shares, the payment of dividends, and even control of the company itself. Companies of all sizes buy back their own stock for a number of reasons, such as to try to pump up the share price or to insulate the company from the possibility of a hostile takeover.
What do you mean by hostile takeover?
There is the acquisition of one company, called the target company, by another, called the acquirer, that is accomplished by going directly to the company's shareholders or fighting to replace management to get the acquisition approved. Then, it can be accomplished through either a tender offer or a proxy fight.
Oh, I know about the tender offer. A tender offer is a public solicitation to all shareholders requesting that they tender their stock for sale at a specific price during a certain time. For example, Company A has a current stock price of $10 per share. An investor who is seeking to gain control of the corporation submits a tender offer of $12 per share with the condition that acquires at least 51% of the shares. In corporate finance, a tender offer is often called a takeover bid as the investor seeks to take over control of the corporation. Am I right, Tiff?
You're right, Livy. Because you already explained about the tender offer, let me explain about proxy fight. A proxy fight is the action of a group of shareholders joining force in a bid to gather enough shareholder proxies to win a corporate vote. These voting bids could include replacing corporate management or the board of directors. Proxy fights also emerge over corporate takeovers and mergers, most notably with hostile takeovers. That is why takeover can be accomplished through a proxy fight.
Okay, now we all can understand better about stocks. Thank you very much, Tiffany, for sharing this knowledge and information to us.
Yes, you're welcome. It's a pleasure for me.
So, this is the end of our segment. We will be back in a few seconds for another section. Please stay tuned. Thank you.
Belum tahu masuk kampus mana? Masuk Atma Jaya aja. Tunggu apa lagi? Buruan daftar. Klik link di bawah. Thank you. Thank you.
Listeners, this is going to be our last segment, but we've got a very special guest, Yustian.
Thank you, thank you.
Okay, our topic is about shareholders' equity. Very interesting.
Yes, of course, it's interesting. First of all, I will explain what is shareholders' equity. Shareholders' equity is the difference between total assets and total liabilities. It is also the share capital retained in the company in addition to the retained earnings minus the treasury shares. The amount that shows how the company has been financed with the help of common shares and preferred shares is also shareholders' equity.
Okay, lots of information there. What is share capital? Is it the same as shareholders' equity?
Yes, it's the same. Shareholders' equity is also called share capital, stockholders' equity, or net worth. People often confuse about the difference between stockholders, shareholders, and stakeholders. Do you know what's this difference?
Oh, never heard of it. Stockholders and shareholders are the same, which means they are the owners and only focus on the return of their investment. Meanwhile, stakeholders are interested parties who are more concerned about the performance of the company, right?
Yeah, that's right. Now you guys know the difference. I will continue. We'll talk about shareholders' equity. Now, equity itself is equal to a firm's total assets minus its total liabilities. It can be found on a company's balance sheet, and it is one of the most common financial metrics employed by analysts to assess the financial health of a company.
Oh wow, so equity is important, yeah?
Yeah, it is important lah. Do you know the difference between shareholders' equity and equity?
Eh? I don't know, man.
Company's equity typically refers to the ownership of a public company. Equity, however, in more general terms, could also refer to the ownership level of an asset.
Hmm, can you give like an example so we can understand better?
For example, about company's equity, investor might own shares of stock in a publicly traded company. Example for equity is an owner of a house with a mortgage on it. It might have equity in the house but not own it outright. The homeowner's equity would be the difference between the market price of the house and the current mortgage balance.
Oh, okay, I think I understand.
Back to shareholder equity. Okay, everyone. Shareholder equity can also represent the net or book value of a company and the amount of money that would be returned to shareholders if all of the assets were liquidated and all of the company's debt was paid off.
Ah, by the way, guys, if you don't know, liquidation is when the assets are sold to repay creditors and distribute the remaining assets to the owners.
Yeah, shareholder equity can also be expressed with this method. A company's share capital and retained earnings minus the value of treasury shares. Let me explain about retained earnings.
I was about to ask what is retained earnings. Okay, please continue.
Retained earnings is part of shareholder equity and is the percentage of net earnings that were not paid to shareholders as dividends. Let's think of retained earnings as savings since it represents a cumulative total of profits that have been saved and put aside or retained for future use.
So it's like emergency funds.
Because the use of total assets and total liabilities is more illustrative of a company's financial health. By comparing concrete numbers reflecting everything the company owns and everything it owes, the assets minus liabilities shareholder equity equation paints a clear picture of a company's finances that is real easily interpreted.
Oh, I see. Now moving on to the next question. Is there any source which we can get shareholders' equity?
Well, there are two important sources from which you can get shareholders' equity. First is the money originally invested in the company and all the other investments that are made in the company after the initial payment, and the second is the earnings that the company has retained over a period of time through its operations.
Ah, okay. Wait a second. Is there only one method
You
or?
mean formula?
Oh, sorry, yes, formula to calculate shareholders' equity.
It's okay. There are two formulas. First one is the difference of the total assets and the total liabilities. It is relatively easy to use and is considered as a basic accounting equation. You need to know how to determine the total assets by adding long-term assets and current assets.
Listeners, you need to know the difference between long-term assets and current assets, okay?
Ah, that's right. Do you know what's the difference?
Eh, why you ask me lah?
You need to answer so listeners will know.
Ah, okay, no worry, no worry. Listen carefully, everyone. Current assets are assets that can be converted to cash within a year, like cash, accounts receivables, inventory, etc. Meanwhile, long-term assets are assets that are not expected to be converted to cash or consumed within a year, like investments, property, plant, equipment, etc.
So, conclusion?
So, current assets are assets that are likely to be converted into cash within 1 year, but long-term assets are those that have a useful life of more than 1 year and usually last for several years, right? Okay, let's go back to the formula, shall we?
Okay, the second formula is adding share capital to retained earnings and subtracted by treasury shares. This is called the investor's equation, where you have to compute the share capital of the company and then ascertain the retained earnings of the business.
Oh, investor's equation. Okay, now this is the last question. What does shareholder equity tell us?
First of all, shareholder equity can be either negative or positive. If positive, the company has enough assets to cover its liabilities. If negative, the company's liabilities exceed its assets. If prolonged, this is considered balance sheet insolvency. For this reason, many investors view companies with negative shareholder equity as risky or unsafe investments. Shareholder equity alone is not a definitive indicator of a company's financial health. Used in conjunction with other tools and metrics, the investor can accurately analyze the health of an organization.
Where can we find all the information needed to compute a company shareholders' equity?
All information is available in the balance sheet. Market analysis and investors prefer to see a good, stable balance between the amount of retained earnings that a company pays out to investors in the form of dividends and the amount retained to reinvest back into the company.
Okay, so what's the conclusion?
Conclusion is shareholder equity tells us the important metric in determining the return being generated versus the total amount invested by equity investors.
Very good. Okay, listeners, now we know what is shareholders' equity, where we can get it, how to compute it, and what it tells us. This will be the end of our topic. Thank you very much, Jostian, for your time here.
Oh, yeah. Thank you for having me, guys.
Be the part of Tugas Atma Jaya.